Recording in progress, it says. So welcome to everyone that has decided to take the time out this morning to learn a little something about preparing your taxes for 2022. Um, there's a lot to learn. I would most certainly suggest that if you have paper and pencil, you may be using it because there's some things you're going to want to jot down. Now, I'll be honest that when I have finished the presentation, which has about, I think, 15 slides to it, I will attach it to the chat box so that in a PDF format, so that if you would like to save it onto your computer and print it off at another time, you may have it, but I just don't want you reading ahead of me. So I will provide it when I am finished, in case there's some things you don't want to write down. I must give a disclaimer to start, and that is that no one person knows it all when it comes to the tax law. There's so much in the tax law. It is always constantly changing. And so if I'm able to answer a question, I will most likely try my best to do so. There may be situations where I cannot answer the question, but if I can't, I probably can tell you where to get the answer, which is probably at irs.gov. Because it requires a lot of research sometimes to get answers to questions, but I will do my best to get those answers for you. For those who do not know who I am, even though most of you probably do know who I am, but my name is Gwen Carney. I do own my own firm, CPA firm, but my CPA firm is Gwendolyn Fosh CPA firm. And I've been in the business since 1991. I think it's almost time for me to retire, but we'll talk about that at another time. So anyway, 1991. But I've actually been doing taxes since I was 16, when we had to do those taxes manually. And if you told me to do a manual tax right now, I would probably tell you you have lost your mind, because there's so much that has changed since I was 16, 50 years ago. So anyway, I'm going to dive into some tax tips for 2022 and ask that you bear with me as I am learning on my own. My husband taught me a few things here on how to go through my slide presentation. So I'm going to hit James. Oh, here we go. Okay, so let's refresh your memory. Let's refresh your memory, because we have to, before I can take you to where we are now, we have to understand a few things about where we were. And one of those things is that the standard deduction has increased over time. So therefore, when you have what's called a standard deduction, which I'll get into later, which deals with being able to get yourself down to the lowest taxable income possible. Because when you get yourself down to a lower taxable income, then of course you pay less tax. But the standard deduction that you have to get past keeps going up and up and up every year, which makes it even more difficult for people to get past it. Because what's happening is the government eliminated exemptions. At one time, you could have 10 folk up on your return, 5 folk up on your return, and you got so much per person. But now that's eliminated. It don't matter how many folk you got up on your return, you're not going to get a personal exemption for each one, which used to be about $4,000 to reduce your income. Instead, they have come up with a standard deduction and made it higher and higher, so that there are persons now who used to be able to itemize who can no longer itemize. There's a cap that existed a couple of years ago for those persons who are itemizing, where there's a section that speaks about taxes, like real estate taxes, personal property taxes, taxes that are withheld from your paycheck that are called state taxes. So there's an area that picks up all of these particular taxes when you're itemizing, and there used to not be a limit on how much you could claim. Because we believe it or not, we have folk who are paying $5,000 and $6,000 a year just in real estate taxes on their properties. And then by the time you take money out of their paychecks, they have passed the 10,000 mark, but that limit is still there this year as well. So you will be capped at $10,000 for a deduction in the area of taxes if you itemize. We also happened a couple of years ago, you can no longer take off miscellaneous items off of your income. Some people used to take off employee business expense. Well, that's out the door. Some people used to take off the fees that they paid to have their taxes prepared. That is no longer allowable. So there are things that we used to be able to deduct on our itemized that we can no longer deduct, even if it's subjected to the 2% rule, they no longer exist. So they're making it even harder for people to itemize. They want you to take that standard deduction if at all possible. But what you need to know for this year, if I need to go back, just let me know, because I will go back. Is there any question on anything I just said there under let's refresh your memory? Does anyone have a question? Because these are the things that are still in place before I get into other things you need to know for the year 2022. Any questions?
Hello, can you hear me?
Who's speaking?
Okay.
Yes, this is Alan Jonathan. We had a question about the employee business deduction. I think you mentioned that in passing, and we didn't catch exactly what it.
Okay, so
yes,
sir. So at one time, when you itemize your deductions, and let's just say for your job that you were working, you had some unreimbursable expenses. I mean, there are people who say use their vehicle for their job to do different things for their job, and the job was not reimbursing them. There are people who purchase uniforms, for example, or certain shoes, for example, that they need to wear on the job. Those things used to be subjected to 2% of your adjusted gross income on the Schedule A if you were itemizing, and they have done away with it. This is like you're going to hear, and without me going into a lot about it, but you're going to hear that people who are using their homes during the pandemic to perform their job, but they were still being paid as an employee, and therefore the use of your home is not a deduction because that's an employee business expense, which is no longer deductible, if you understand what I'm saying. So there are people who really thought that, oh, well, I'm using this room now, I'm using this space, I'm using my paper, my ink, whatever, but you're an employee. So as an employee, that's a business expense that's no longer allowed. Did I answer your question?
Yes, you did. Thank you very much. It's a very thorough answer.
You're welcome.
Hey, Gwen.
Yes.
This is Janice. I use my personal vehicle as a volunteer for the Red Cross, say for instance, when I drive to fires and disasters.
Yes.
I don't file the mileage anymore?
Yes, you can file the mileage, and I can get into that. It can only be filed on Schedule A if you are itemizing. That is what's called charitable mileage, which is volunteer service. Volunteer miles are deductible providing you are itemizing your deductions. So that's going to be the heartache this year that I will get into momentarily about charitable donations and being able to deduct them using Schedule A. So if you are using Schedule A, then yes, the answer is yes. You still will be able to put down the number of volunteer miles that you incurred and get reimbursed, as a deduction. I think it's 18 cents a mile, I believe that they're giving, if not higher. Any other questions?
Thank you, Gwen.
You're welcome. So what do you need to know for this tax season? First of all, the starting date has already begun, which was January the 23rd. And right now the deadline is April the 18th. As not the 15th, I can't remember, the 15th must fall on a Saturday or Sunday, I guess. And then that Monday is a holiday in DC. So that's why they made it the 18th as the date for your deadline. And then of course you can get extensions until October the 16th to 23rd, but don't make this mistake. Just because you need an extension does not give you the extension to pay your money. A lot of people misunderstand that whole concept. Whenever you are filing an extension to the government, all you are saying to them is that I need more time to do your paperwork, but here is your money. Now, guess what? If you don't have the money, what's the purpose of the extension? Because if you're not sending them nothing, you still will get penalized anyway. So you don't need to ask for an extension if you're not going to send in the money, because that's the purpose of an extension. I need more time to give you your paperwork. Now, this only applies to people who owe. This does not apply to people who are getting refunds. If you're getting a refund, you have 3 years to ask for your money anyway. So you don't have to ask the government permission to take longer to ask for a refund. No, because you have 3 years to ask for the refund. This is only for those who know that they're going to owe based on previous history. And so therefore they need more time to do the paperwork, but you're not allowed more time. Well, I don't say not allowed. You got money to give away to the government, then by all means. But I'm saying that you don't want to have to get a government any more than what you need to get a government. So you need to settle that by the 18th of April. Now, in all honesty, those who are used to filing what I call estimated tax payments during the year, our last estimated tax payment for 2022 was actually January the 15th. So we usually have until January the 15th of the following year to send in the rest of our money for that previous year in the way of estimated taxes. So if we send that money in, then we have no reason to worry about an extension, because the whole point is that the IRS has their money. Do I have any questions on that? Because that's what an extension is, just more time to file, but not an additional time to pay the money. Any questions on that? Okay, if you collected unemployment, sure enough, the income is taxable. One year when we were going through the pandemic, the IRS was nice and then told you that the first $10,000 of your unemployment money would not be taxed, and they honored that. Well, they're not honoring it anymore. Last year they took it away, it's still gone. If you received any unemployment compensation, you will get taxed on every dime. And a lot of times people don't realize you can ask the unemployment people to take out federal taxes while you're busy paying, while you're busy receiving the money as if it was a paycheck, and have them take the taxes out while you're getting it, instead of waiting till the end of the year and have to pay the taxes. So you have an opportunity to do that as well. The next thing I want to talk about is, if I could get you to remember last year, when it came to charitable contributions, last year, the government gave everyone a $300 above the line contribution deduction, whether you itemized or not. So if you contributed at least $300, and this is a single person, the deduction was $300. If you were married, the deduction was $600. You could still reduce your income by that $300 or the $600 if you did not use Schedule A. Well, they have taken it away. It's the biggest change that has been made in the past 2 years. So I'm gonna tell you right now, if you cannot itemize, you will not take away charitable contributions at all, not one dime, which is a shame. But later on, when I get into this presentation, I'm gonna pick on maybe like a single person and just show you how much a difference it makes when you're able to itemize versus not. But anyway, just want you to know, and you have up to 60% now. You'd be far-fetched to give away 60% of your adjusted gross income, because that sounds like you ain't got no money left over for yourself. So I don't know how people give away 60% of their adjusted gross income, but the government does allow that much to be deducted on Schedule A. That doesn't mean it doesn't flag anything. I'm just telling you, you're allowed to, that's the max. But for those persons who are not able to itemize, you can forget about contributions. You will not get that $300, and neither will you get the $600 for married couples. Any questions on that? Because that is a big one to me. Because everyone, if you just gave $300 or $600 last year, you were able to reduce your income by it, even if you didn't itemize. But this year you shall not. Any questions? The next thing they eliminated, which is going to be a shocker to some, is mortgage insurance premiums. Okay, so there are people who are paying mortgage insurance premiums because they did not have their 20% when they went to buy their home. They didn't have the 20% down payment, so they had to purchase mortgage insurance as a part of their closing. And so now they're paying that as a part of their mortgage. And it comes out on your 1098 that comes out for your mortgage interest statement. There is a block there that says mortgage insurance premiums. It used to be deductible on Schedule A. It is no longer deductible, and I know that that's a big one as well. So no longer can that be itemized when you are filling out your Schedule A. Sorry to say so, I'm just a messenger, but it's true. You shall not deduct insurance premiums. I guess until they decide to put it back, but right now they're saying no longer deductible. The one thing I did see that they are pushing though is the residential clean energy credit. So I know most of us have received that phone call about getting solar panels put up on our roofs because it's going to save you money in the long run. I'm not here to sell you any kind of solar panel. I'm just trying to tell you that the government is going to help you out if you do choose to buy it. But it's only going to help you out this one time now. So they're going to give you back 30% of the cost of installing those solar panels. But there's no cap on the amount of the credit, and it has nothing to do with your income. If you purchase those panels in 2022, you just let your tax preparer know and give them the proof of it. Just don't tell them, oh, I put some solar panels up, because I'm going to tell you right now, you're going to prove it to me. I'm not getting ready to fill out no credit form with 30% deduction, and you ain't showed me the first dime of spending for these solar panels, okay? So, because I happen to know somebody that did that, but they didn't have solar panels. But anyway, but that's between them and the government. I ain't got nothing to do with it. But what I'm saying, I didn't prepare that tax return either. I just happened to ask the question. Oh, you got solar panels last year? He said, I didn't get no solar panels. I said, oh, well, somebody gave you a credit. Whoever prepared those taxes got you a credit last year. But anyway, this is true that they will give you 30% off, and a credit on a tax return is the best way to reduce taxable. It is better than a deduction. To get a credit is much better than a deduction. So because that's dollar for dollar. your taxes are a certain amount, and they give you 30% more off, that is dollar for dollar to reduce your tax bill versus having a write-off of a deduction. But the other thing they're trying to promote is those who have purchased the electric vehicles. I don't know a whole lot about that. I'm gonna leave that up there for a minute for y'all to read and understand what they're talking about. But it looks like $7,500 credit, but it depends on the capacity of the battery. And then those who bought their vehicles between August the 17th, 2022 and December the 31st must show that the vehicle underwent final assembly in North America in order to qualify. And that's because the requirement doesn't apply to vehicles purchased earlier in 2022 when this act wasn't signed. So there's a whole lot out there on irs.gov about the electrical vehicle tax credit. For those who want to know more about it, I just thought I would let you know. There is such a thing, just like that residential, those solar panels is new. It's also the electrical vehicle tax credit is also out there. Do I have any questions right now from what I have gone over so far?
Hey, Gwen, I had
I'm
a
not
question.
finished with what you need to know for this season.
Hey, Gwen, I had a question about the solar panels. Your screen says 30% of the installation cost. Your installation cost separate from the cost to purchase the panels, or is that installation including you're buying the solar panels? So
I believe it was the entire product. I believe it was the entire product because that's the only price I had on there. It actually didn't separate it. You understand? The invoice did not separate out, oh, this is what you pay for the product and this is what you pay for installation. Because most installations include the product. So that's the best way I can answer that. Any other questions?
This is Pamela. I have a
Pam, you're muted.
Okay. I have a question about cars. If we
Yes.
buy a hybrid car in 2023, do you know if it's going to be a tax credit or a deduction?
So are you telling me a hybrid car is an electric car?
John?
No, it's not.
It's
Okay,
not an electric car.
It's
no,
batteries.
I don't think this is about hybrids. I really think this is about your Teslas.
Oh, okay.
Your
So
electric, your plug-ins.
okay, only electric
Yeah,
cars.
your electric plug-in cars.
Okay, thank you.
You're welcome. Any other questions? I'm going to continue on with what you need to know for this tax season. I want to tell you right now, y'all need to say goodbye, 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 goodbye to the pandemic era tax credits. So many tax credits expired. There were no stimulus checks issued in 2022. The child tax credit, the earned income tax credit, and the child independent care credit have returned to the pre-COVID levels as shown below. And so here you go. Notice this is the biggest one. That very first one that says CTC, child tax credit, children under age 17. In 2021, the government gave you $3,600 as a credit per dependent. It has gone back down now to $2,000. Same thing with earned income tax credit. That's what EITC is, earned income tax credit. And right now I'm only dealing with those with no children. So those with no children in 21 got $1,500, but in 22 you ain't getting but $500. And those who pay for child care for their children, the maximum credit was $8,000 in 2021. The maximum credit is $2,100 in 2022. Big difference. Big difference. So let me give you a little story about a young lady that actually could not understand when I told her that her refund this year was substantially less than the year before. And she kind of tried to keep telling me that I was making a mistake. I kept telling her, I'm not making a mistake. I didn't make no mistake. You're about to make a mistake because it doesn't matter who you take this cut dry tax return to. You're going to get the same answer. If they gave you $3,600 last year for your child, they reduced it down to $2,000. Guess what? Your refund just went down by $1,600. Let's just start there. And to put injury on it, this same young lady did not pay attention, which I can't say a lot of folks don't. They don't pay attention. But every year when your job starts paying you again, whether even if it's retirement money, even if it's going to work every day, you need to pay attention to what you are bringing home because the tax tables keep changing. And if you don't pay attention to the fact that your tax table has changed and they are taking out less money, you think you're making more money. You're not making more money. You are bringing home more money because they lowered the amount of money they're taking out your check. And then you get to the end of the year and Lord behold you, you did not give them the same amount of money you gave them the year before on the same income, if not more. So this young lady paid no attention to the entire year working for 2022 because in 2021, the government took $5,000 from her paycheck. She made the same money in 2022. Guess what? They only took $3,000. So now she want to know how come her refund ain't the same. Well, you just gave them $2,000 less and you just lost $1,600 on this child tax credit. Well, your refund just went down by $3,600. And she thinks I made the mistake. She gonna find out in a minute. I ain't made the mistake. Take it to somebody else. They're gonna give you the same answer. You're not gonna get that $6,000 refund you got the year before. Impossible. Impossible. I just showed you $3,600 right there. You're not gonna have. Do I have any questions on this presentation right here of earned income credit, the child dependent care, and the child tax credit? The average person who was used to getting these things will feel the effect. You're not going to bring home, you're not going to get the same refund you got the year before. That's actually impossible. Any questions on this chart? Okay. Now, let me enlighten you on the 7 tax brackets there are for 2022. And I'm gonna let y'all study that for a minute because I'm gonna take you through a scenario in a second. And those of you who have paper and pencil, I'm gonna let y'all write this down with me as I go over it. For those of you who have paper and pencil, who I'm gonna pick on, I'm actually gonna pick on someone single. Okay, so let's write this down. Let's pretend I have a single person who has made $60,000 for the year. So let's write down the $60,000 for the year. And if we look at the chart, let me just let you know this. Out of the 60,000, the standard deduction for that person, this person doesn't itemize now. The standard deduction is $12,950. So we're going to subtract $12,950 from the 60,000. And when you do that, you should have a taxable income of $47,050. That's what you should have if you do the math. If you look at the chart, that $47,050 is in the column under single at the 22% tax rate. Does everybody see that? That single person who has taxable income of $47,050 is going to pay 22% on the $47,050. That's what's going to happen. But I dare to say that instead of having a standard deduction of $12,950, let's just pretend that this same individual could have itemized. And let's just pretend that this person had an additional $5,275. I'm talking $5,275 more in deductions so that they could have itemized. Well, If you look at that and say, well, if I take 47,050, and from that I subtract out 47,050, and I'm gonna subtract out $5,275. I said that if this person could have itemized, that brings their taxable income down to 41,775. And guess what? I need you to see that their tax bracket now is 12%. Their tax bracket is no longer 22. Their tax bracket is 12%. Well, that's a 10% difference. A 10% difference in taxes just to have an extra $5,200 deductions. Wow. What a difference. And if you can just imagine, this is even worse for a married couple, a head of household, because when you cannot itemize, you have just given the government more money. You're in a higher tax bracket. Okay, so I wanted y'all to see that for a minute, because it's a matter of whether or not you are able to itemize or not. So the next chart that I show you will give you an idea how they have raised the amount from 12,000 in 2018. A single person had to have 12,000. Now they need 12,950. But look at a married couple. Y'all got, if y'all do married, found jointly, you got to have over $25,900 in order to itemize. That's a lot. For those who are not paying a mortgage, real estate taxes, property taxes on your vehicles, and giving away all the clothes in your closet, or some of them clothes up in your closet, or going to the bank and give away your money, you will not be able to itemize unless you get yourself up over that level. So, you know, your single persons sometimes have a better chance, because the average person, if you are working, you know, I don't know what the average salary is for our young people out here right now. But let's say even if they were making $60,000 a year, 3,000 of that is probably state taxes. But hopefully they are paying for a house and have mortgages, and the average mortgage now is $1,500 to $2,000 a month is your average mortgage, and trust me, 80% of that is interest when you first start out. Matter of fact, 90% when you first starting out. So there may be single persons who can get over that 12,950. It becomes more difficult for a married couple to get over the 25,900, because keep in mind, earlier I told you how they are stopping us with this, with the taxes coming out and capping us at the 10,000. So if you're going to cap us at the $10,000 for taxes, that means we have to get the other $16,000 elsewhere. And elsewhere deals with mortgages, and it deals with contributions. The average person cannot take off medical. The reason being, there's two reasons. One is, if you are still working, most likely your medical insurance premiums are pre-taxed anyway. So your W-2 is already being reduced by the premiums you're paying for medical insurance. So you can't have it both ways. You can't take it on Schedule A and get it at work pre-taxed. But the other reason is that medical must exceed 7.5% of your adjusted gross income. And that in itself is very difficult. If you make $100,000 as a couple, you got to have over $7,500 in medical, and only that which exceeds $7,500 will be deductible under medical. So I just want everyone to actually see this, so you can understand that it's not going to get any better. Each year, that standard deduction is going to go up. So either you're able to itemize or you can't. So it's a matter of, doing your homework, deciding, and you know what, and the bad thing, you can't do your homework when the year over. When we get to December, it's too late to do the homework. You got to do your homework early, like now for 2023. You can't get in January 23 and think you about to fix something for 22. The only thing you can fix for 22 is to put money in IRA. And even that is limited. So you understand? So these are things that if you want to fix your taxes, you need to do your homework in the beginning of the year and keep at it. Pay attention to what they're taking out of your retirement checks. What are they taking out of your your W-2s? And I have run into a lot of clients who didn't realize that their Social Security money is taxable because of the other money they're receiving, but they didn't know they could ask the Social Security Administration to take out the federal tax. Social Security is not taxed by the state. It is only taxed by IRS, and that's if your other income puts you over a certain level. Well, then you can always ask the Social Security Administration, hey, can you take a little bit out, whether it's 7%, 10%, 12%, 20%. You can ask them. They have 4 brackets that they take out that you have to choose, but you have to ask them. They are not going to automatically take it out. Do I have any more questions, any questions whatsoever before I move you on to, I just want to do a little bit about earned income credit, and then I'm going to try my best to get you over to what you need to know for the state of Virginia. So, yes.
Could you say something about your note at the bottom of this screen, the standard deduction?
Okay, yeah. So what happens is, yeah, so for those who are over 65 or blind, and you are not itemizing, your standard deduction goes up by another $1,750 each. So you see that married couple that had to have $25,900. Well, both of y'all 65 or 165 and one is blind. Okay, add the $1,750 to the $25,900, and that makes you have to have even more to be able to itemize. Got it?
Thank you.
It has to be both of you over 65?
Oh, no, just one. No, it gives you $1,750 per. So if only one of you is over 65, then the standard deduction will go up by $1,750. Did that answer your question?
Well,
Yeah,
Gwen, that
mine.
Thank you.
I don't like the answer, but thank you.
Gwen,
Yes,
Gwen,
ma'am.
my question is, if you itemize and you're 65, you're not taxed that additional $1,750?
That's correct. Because if you're itemizing, that means you were able to get over and above their level for standard deduction.
Okay.
And that's why I'm pushing itemizing, because itemizing just opens you up for so much more. It helps really lower your taxable income, especially if you're in a higher income bracket.
Now, the next question I have is, if you're paying off your house, say like 4 months into this year, and that's about the biggest thing you have other than to pay taxes on it after that, then what would that look like for the 23 year?
Okay, so what happens is, if you pay off your house, then that means that you no longer have an itemized deduction for mortgage interest, which used to be one of the biggest deductions we had on Schedule A. If you no longer have that, then the only way you can itemize is to make it up doing something else. And the only area right now that I know of to make it up is in contributions. Contributions right now, you can give up to 60% of your income and it's still deductible. So, but contributions does not necessarily mean that you gave out dollar bills. It also means that you could have cleaned out your closet. You could have cleaned out the attic. Take pictures, take an inventory. And like I tell every year when I do this, there's a website called It's Deductible. ITS Deductible. ITSdeductible.com. It is owned by Intuit, which owns TurboTax. It is a free website. where you can go on, and every time you make a trip to Goodwill, Salvation Army, you go into this website and you record that I went today, February the 11th, and I delivered the following items. And you are made to itemize what you just gave. Well, don't nobody know what you gave but you. Even they don't know what you done gave. But if you gave away 30 pair of pants, then put down 30 pair of pants. It already has the price there for you, which is probably like $15 a piece. So you keep doing that, and you're allowed to print that off and let that be your support for why you are taking such a large deduction for contributions, because all contributions are not necessarily cash. Some are non-cash. And so that's how we have to do it, Mary. We have to still get over and above. And if you're single, $12,950, getting over and above it. But if we don't have the mortgage interest, we have to have something else. And like I said, the something else has got to be contributions, because you still have your real estate taxes. You'll still have the property taxes on your vehicle. You will still have any state taxes that came out of your retirement money. So contributions is it. Any other questions? You're welcome.
That's it. Thank you.
You're welcome.
Yeah, there's a hand raised.
Gwen. Hey, Gwen. Good morning, everybody. It's Gwen Davis.
Good morning, Gwen.
Good morning, Gwen Carney. So, but it's deductible. Can I also do that for like the Bethel Boutique?
Yes, ma'am. You can put the Bethel Boutique in it as well. Yes, ma'am. And you still just put in your date and your itemized deductions, you know, as far as what did you give away in inventory. So you have to understand, the most convincing thing you can do for the IRS or anybody else is to show that you at least try to calculate what you gave or take pictures. Anybody can sit there and say, oh, that was valued at $1,200. Prove it. How can you prove that you, or did you just pick that number out of a hat? Because see, your IRS don't like them even numbers. So y'all, if y'all think even numbers is the way, I got news for you. Even numbers have not been calculated because they ain't coming out even. They're gonna come out odd if you do it right. So go on to It's Deductible, put in your inventory and let it calculate it for you. And then when you see that when you go to put in your contributions, it says 5,931, it's because it was calculated. It wasn't an estimate. And that's more convincing that you've calculated it. The other thing that's convincing is to take a picture. Take a picture of that pile of clothes before you take it. Take a picture of the 10 bags before you take it over to Goodwill. What's wrong with a picture? We got to take pictures of everything else. Y'all little selfies. Y'all take pictures of everything else. Take a picture of the inventory. That'll help you out. Wholeheartedly, that will help you out. Any other questions on that contribution? Because I know that's the loophole. I already know. I know that that's it. Because don't nobody know what you gave Goodwill. Salvation Army either. They can come pick up your whole living room set. Don't nobody know, did they come get the living room set, or was it just a chair? I'm just saying, who knows? Okay. I ain't telling you, I'm not trying to tell no story. I'm just trying to give you reality. Reality is that the loophole right now is charity. It's contributions.
Yes.
It's not cash contributions, not the real contributions. Contributions by cash got to be proven. But contributions that are non-cash, you just need the receipt. But you need some type of inventory so that you have proof that this is what I took to Goodwill. Question? No more questions? Okay.
Nope, thank you.
You're welcome. I'm gonna move on to my next slide, which talks about earned income credit. And so I just wanted you to see that if you did not have any children, but you were single and didn't make over $16,480, the government is going to give you a credit of $560. I just need you to see that. So you have people who are single, don't have any kids, and didn't make much money for the year. They're independent on their own. They do get earned income credit of $560. And you see the same thing happens if you are married, but your income can go up as high as 22,610. Now, see, that doesn't look fair to me. It's two people now. The married, you see that married filing jointly, maximum earnings 22,610, but had that been two single people, we've been talking $33,000 because each one was 16,480. But they're capping it at 22,610. You also, that note at the bottom means that if you have investment income of 10,300 or less, then you're still eligible for earned income credit. If you got investment income of 10,300 or more, you're not eligible for earned income credit. It depends on your source of income. So your source of income really needs to be the W-2. Any questions on this chart? I'm getting ready to get into the state of Virginia. So
Gwen,
yes.
this is Joe Barton. Good morning, everyone.
Good morning, Joe.
Gwen, I have a question. I know at one point in time, I know we can't claim it now, the home equity line of credit. But I understand if you're doing improvements to your home, like if I did significant improvement, like siding or something like that, or redone a roof, how much of that is deductible?
I don't know that there's a limit. I don't know that there's limit. It's mortgage interest, because I think the limit goes all the way up to something like 750,000 in interest. So it's a high number, Joe.
Okay, so the interest that I paid on that would be the amount that I could, claim.
Yes. And it should have came to you on a 1098. So as long as it was reported to you on a 1098,
yes,
then it was turned into the government.
Okay, great. Thanks.
You're welcome. Any more questions before I get into the state?
Yeah, I have a clarification question about
Mary.
the tax rebate that Virginia handed out to a whole bunch of folks. I happened to see something on.
Yeah, and I'm going to get into that. Yes, I'm going to get into it, Marianne, when I get into the state of Virginia.
Okay, good enough.
I'm going to cover it because I have it right here.
Hey, Gwen, what is the bottom investment income limit? $10,300 or less? What is that?
Yeah, what I said earlier was that if you have income, this is based on your income on your tax return, and it's saying that. But if your income came from investments, then you are limited. In other words, you cannot have over $10,300 in investment income. And I guess you say, who in the world's got that? Okay, because whoever in the world's got that, you tend to wonder how come they're eligible for earned income credit, in all honesty, because we don't make but 1 cent on the dollar now. So it's like, you ain't making but 1 cent. Some people might be making 3 cents. But they're saying for earned income credit, this person here, that this single person that has 16,480, they're saying that no more than 10,300 of it can be from investments. That's what that's saying. No more than 10,300 of it can be from investments. Okay, everybody understand that?
Yes.
Okay.
Gwen, I wanted to add a follow up to Joe's question.
Yes.
I didn't quite understand what he was asking.
Okay, so there are different types of mortgage interest. Some people's mortgage interest is coming because they have a first mortgage. Some people have what's called a line of credit, an equity line of credit, where they have borrowed against their home. And so therefore they're still paying it back. And what I was saying to him is that the law allows still for the deduction of the mortgage interest. And it's a high number. I don't know it by heart as to what's the limit that you can deduct.
So on a HELOC, you can still deduct the interest?
Yeah, if you receive the 1098. That's why I said, I asked the question, did you receive a 1098 from the mortgage company? Because that's what's reported to the IRS as deductible interest.
And that's different from
the form?
A home equity loan?
Yeah, so a home equity loan is treated the same. It's still mortgage interest.
Okay.
Yeah.
Okay.
Uh-huh.
I thought for some reason, I thought they had done away with something related to that, but I guess I'm wrong.
Well, some things are, depends on whether or not probably things that are new versus, how you can grandfather in some things, like I've always had this mortgage interest, this line of credit because I did certain things. Well, now what they limited was what you can do with the money. In other words, some people were getting those kind of loans and going out buying groceries. But they stopped that. If you're gonna get that kind of loans because you did something major to your home.
Okay, I got it. Okay.
And I thought that's what Barton asked me. He did something major to the home.
Right.
Yes,
Right.
I did. Mhm.
Okay,
Thank you.
you're welcome. Any other questions before I get into the state?
Hey, Gwen, I have a
Hey,
question.
Gwen, I have a question.
Yes.
I'll go next. I'll wait.
Okay, who's going next? Karen?
I will. I think didn't they get rid of you being able to use your home equity to buy like cars and that sort of thing?
That's correct.
Has to
That's
be
what
a
I'm
true
saying. So
home.
there's some
Yeah.
things they eliminated,
Right.
that you can't just go get a home equity line of credit and go buy up.
Right.
But if you're doing something major, I think
Then
to
your house. It has to
your
be your home.
house, it's deductible. Who else had a
So
question?
Gwen,
Yeah.
hey, it's Gwen. So Gwen, my question is, what if you do something to your home, but it's not, the proceeds are not from a home equity, that is out of pocket?
Well, then you ain't taking off nothing because the government wants you in debt. So thank you very much for using your own money, but you're not about to deduct that unless you got rental property. That's a whole nother story. I'm not going over rental property today, but your own primary residence, you cannot deduct fixing it up. And you haven't gotten in debt to fix it up. No. That's not gonna work.
Only in America. Only in America.
But I ain't got no problem with creativity. I'm just saying there's some things we can't do. Okay.
I'm gonna work on some creativity. That's what I'm working on.
Any other questions on that before I go into the state of Virginia? Okay. What do you need to know for this tax season for the state of Virginia? The first thing, and this is a biggie. So if you can remember, last year, the state gave a standard deduction of $4,500 if you did not itemize with the federal government. So persons who were single or married filed separately, last year, 21, your standard deduction was $4,500. This year is $8,000. Married couples, your standard deduction last year was $9,000. This year is $16,000. So that leads me to what transpired this past week. So I need everyone to put on your thinking caps for a minute because I went through a logic. When the IRS put out the word earlier this week, oh, y'all better not file your taxes yet because some of y'all are gonna have to pay taxes. We need to find out whether or not y'all need to be paying taxes on those rebates. And I think it was 12 or 13 different states that gave out rebate money. But what they found out is, because paperwork just came out, I printed it off yesterday, was what they found out is that out of those 12 or 13, there are only about 3 or 4 of us, and Virginia is one of them, that the purpose of our rebate had nothing to do with the pandemic. And I'm gonna explain. If in the state of Virginia, in order for you to receive that $250 per person last year, the only way you got that $250 is because you paid into the state at least the $250. There are people who filed their taxes for 21 and did not pay state taxes whatsoever. They did not get that $250. I know they did. The only persons that got that $250 are those who paid the government kept at least, the state of Virginia kept at least $250 of your money, and that's per person. So married couples, that was $500. Single persons, that was $250. Now, where I need you to put your thinking cap on is if you normally do not itemize, just think about it. If you normally do not itemize and you get a state refund, you have never paid taxes on that refund, ever, because you didn't itemize. The only people who pay taxes on that refund are those who itemize because the government allowed them to reduce their income by the amount of state taxes withheld. Anytime they return any of it to you, it becomes taxable in the following year. So now they just return to you, if you itemize, they just return to you $250 per person. Yes, it's taxable in the state of Virginia if you itemize. But if you did not, it's not taxable. Does anyone understand? If you did not itemize in 21, that rebate is not taxable to you because that was not, I'm gonna tell you why they gave it to you. The reason why the state gave it to you because of these two things you see up here right now. The standard deduction was not fair when y'all did your 21 tax return. I just told you the standard deduction for single people was $4,500. The standard deduction for married couples was $9,000. But they weren't up to date with the federal government. Do you recall there are a lot of people who no longer can itemize with the federal government? That means they cannot itemize with the state. But the state had not changed their standard deduction rates. So therefore, people were paying more taxes to the state than what they would have otherwise paid because they had not done their homework yet. So then when they did a little homework, they said, oh, let's just hook everybody up. It was better to hook everybody up than to pick out those that they were not fair to. Because the ones they weren't fair to are the ones that did not itemize. Those are the ones who paid the most taxes to the state if you were not able to itemize. But instead of the government, state of Virginia, doing their homework, they said, okay, you know what, let's just give everybody a little something. So for some of us, that little something, you just gave us back some state taxes that we had already deducted from our income when we itemized, which is why we have got to show it now as a return of money. But those of you who did not itemize in 2021 don't need to worry about it at all. Do I have any questions on that? I try to explain that as best as I could because it all depends on whether or not you itemize in 21 as to whether or not that's taxable income to you. Any questions on that?
So if you itemize in 2021 on your state taxes, that means that this year we're going to have to pay federal taxes on the refund. Is that right?
Correct. Absolutely, you said it exactly right. And really, the only way you can itemize on state is because you already itemized on federal. And if you look on your Schedule A, you will see there's a line item on Schedule A under taxes that says state taxes paid. And so that state taxes paid is money that came out of your retirement, money that could have came out of a W-2. If state taxes paid out, you were able to reduce your income by it. So the following year, when you get any of it back, because you reduce your income the year before, you pay tax on what you got back. And I'm saying that the government gave you back another $250 or $500 for married couples, and it becomes a part of taxable income to the federal government. Yes.
Hey, Gwen, the state usually sends you a little something to indicate how much that was. So will that $250 be included in the refund if you got a refund and itemized like this?
So this is what I saw this year. What I saw this year was that the state sent you a form saying this is what we gave you in the way of a refund. Now they even sent it to you if you only got the $250. There are people who only, I'm an example because last year I paid the state So I because I paid the state, I did not, I really did not show that as income, I don't think. But when I paid the state last year, I got to deduct it. That's what it was. I got to deduct it when I paid the state. But because they turned around and gave us the rebate, now I got to show the $500 now as income. But they only sent me the $500 as income because I did not get a refund. When I filed my taxes, I paid. So if I pay state taxes, I don't get something from the government, from the state of Virginia said, oh, by the way, we gave you X amount of dollars. Normally I wouldn't have got it, but I did get it because they sent me the rebate check of $500. So now I have to include that as income because I had deducted on my Schedule A all that I had paid them that year. But because they gave me $500 back, then I had to record it. So I don't know if they sent out 2 statements or 1, but it should be out by now. There's no reason why you should not have in your possession by now what the state's saying that they gave you in the way of refund. Has anyone under the sound of my voice received more than 1 statement from the state of Virginia? Because I did not. I only received 1. Anybody on this call? No? So maybe so, Barton, maybe they put it all in 1 statement because I personally only got the 1 statement. Was that your question?
Yes, that was my question. Was it, they're gonna get 2 separate ones or just like you got 1, but you got 1 because you paid. But I'm saying I got a refund last year. So I know the refund amount is income at the federal level. Now, is the rebate gonna be a separate thing telling me?
Okay, so I can tell you how you can tell.
Okay.
Okay, so, all right, I got the answer. The way you can tell is that you need to look at your tax return for 2021 to see what your refund was.
Right.
And to compare it to the statement that they sent you this year to see if it's a difference.
That's
if it
right.
is a difference, it's because they picked up the $500 for married couples.
Right.
Okay.
Okay. Okay. Thanks.
Thank you.
You're welcome. Any other questions on this before I move on? The filing deadline is still May 1st. Please make sure they have their money, just like the federal government wants their money. So does the state of Virginia. They want their money. So the taxes are still due, but you don't have to ask for extensions. Extensions are automatic with the state of Virginia for 6 months, but they need their money. And this is going to be a surprise to most people. I don't know if I have anyone online with me right now who's a military retired veteran that is at least 55 years old. But your Governor Youngkin has approved a bill that is giving those military persons who are receiving retirement pay. Now, this ain't folk who are still on basic training or whatever. This is retirement pay, because it does say military retirement pay. So persons receiving that, Governor Youngkin has approved that the first $10,000 will not be taxed by the state of Virginia for the year 2022. It goes up. So right now it's 10,000 that will keep increasing every year by another 10,000 until we get to 2025, and there'll be a subtraction of 40,000. So for 2023, your deduction will be 20,000. Your deduction will be 30,000 for 2024 and 40,000 for 2025. That is only for veterans aged 55 and older who are receiving military retired pay. There is just tell your tax preparer, hopefully they notice it, but our form is the 1099-R tells us the source of the income. And every one of them that I've done so far, the source of the income, it says military retired pay. That's who it came from. It says it. And so there's a line item on subtractions from state taxes. And that line item for subtraction for state taxes allows you to take off $10,000 this year just for the state of Virginia. This ain't a federal law. This is just the state of Virginia. Any questions on that gift? Because that's exactly what that is. That's a gift to the military. Okay. So if you itemize on the federal, you must itemize on the state. But there are some additional deductions that you can take on the state. The first one deals with licensed school teachers deducting 20% of unreimbursed tuition costs. The next one deals with premiums for long-term care. Because remember earlier, I said to you, a lot of people cannot deduct medical on Schedule A. But if you cannot deduct medical on Schedule A because you don't have over 7.5% of your income being eligible for that deduction, but you did pay premiums to long-term care, make sure your tax preparer has it, because long-term care premiums are deductible on the state side of the house, even if you did not take them on the federal. And then if you purchase certain energy efficient equipment or appliances, they are giving you up to $500 for single. And listen to this, it's not 20% of the purchase, got that? It says 20% of the sales tax paid, two different numbers. This is 20% of the sales tax paid. I guess something better than nothing, but that's a big difference between paying $500 for a washing machine and only paying $25 in taxes, okay? Because 10% of 25 is what? $2.50. Okay, so I'm just giving you an example that last one is 20% of the sales tax paid on certain energy efficient will be deductible on the state. Any questions on any of these before I take you to the next thing you need to know for the state of Virginia? Virginia College Savings Plans, prepaid tuition, they're deductible up to $4,000 by the owner of record. So, you know, some of us have them for our grandkids, you know, the 529, College America and College Wealth. But it does save taxes on the state side only. This does not help you on the federal side, but it does help you on the state side to have that.
Gwen, this is Pamela. I want to ask you a question.
Yes.
Is it 4,000 cap, or if you have more than one grandchild, 4,000 per grandchild?
It's 4,000 per grandchild.
We're gonna be getting.
Yep. 4,000 per. Any other questions? I want you to also to see the 2022 Virginia income tax brackets. And I just want you to study that for a second, because if you look at it, you'll see this, it's not fair. I said this last year when I did this. Now, ain't like the state of Virginia listening to me because they ain't heard a word I said, but this right here ain't fair. If you just look at it. So everyone pays the same amount. It doesn't matter if you're single, head of household, or married. If you didn't make for $3,000 taxable, then you only pay 2%. Same thing at the bottom. If your taxable income is $17,001 or more, it doesn't matter whether you're single, head of household, or married, you're paying the same tax rate, 5.75%. Even the federal government gives you a different tax rate based on whether or not you're single, head of household, or married. but not the state of Virginia. Everyone pays the same rate. Does not matter. Any questions? Okay. Now I'm going to take you to some suggested steps to take now so that you can file your taxes and avoid processing delays. Now, I mentioned earlier about irs.gov because there's a lot of information out there, and sometimes it does help to do some research on your own. I take issue a little bit with those who expect your tax preparer to be able to answer every question there is at tax season. Some questions that come, it would have been better had we had it prior to our busy time. But when we get into a busy time, we don't have as much time to research because some things take more research than others. Like right now, if they're just now putting out the thing about the plug-in electric cars, and they just put out the thing about residential credit, then that's going to take some research. And there's some subject matters we can research, but it's like we can't possibly know the answer to it all at one time, right when it's being asked. So it's a matter of helping us to help you as well. I think it should be a team effort. But I don't mind personally researching. I'm just saying it does help when other folk have also researched, because some things are left up to our own interpretation, believe it or not. Sometimes you will interpret something totally different than I would interpret. You shouldn't be, because the law is the law. But, you know, anything you can help would be greatly appreciated. I say file your taxes electronically, because truly it is faster. Now, the funniest thing to me, I was argued down, not really argued down, that's not the best word, but it was said to me the other day when I asked the young lady who had to do an installment plan to pay her tax bill. I said to her, I recommend that the IRS take their money out of your account every month to pay your taxes for a couple reasons. One, you don't ever want to miss a payment when you have signed an agreement with IRS, okay? You don't want to miss a payment because they can come back and ask for it all. But by setting up the payment plan to come out, it's on them to take it out on the date you said take it out. Her reply to me was that I don't want them to know my account number. I'm like, really? Really? You think they don't know your account number? Guess what? There's a whole lot they know that you have no foggy idea. Let's start with every one of your credit card numbers. Let's start with every one of your investors. Oh, so you don't think they know? They do know. There's no way they don't know. How do you freeze people's assets if they don't already know the accounts? So guess what? I was trying to give you a way just to make sure they don't come back and haunt you later, to allow them to take it out directly. The other things people we don't do, we need to take our time, look through your checkbook. You would be surprised at the things that you could have possibly paid for that would have been truly a tax deduction, but you overlooked it, forgot it, and that's your answer sitting right there looking at you. So how do you know that your church gave you an accurate statement of contributions? How do you know that if you haven't checked to make sure every check was included? Unless you go through your checkbook and add it up. Because hopefully you recorded it, even if you paid it online. But you wouldn't know if you don't do your homework. So if you're trying to save money, you don't want to get IRS with so much, then by all means, take the time and gather your information, but go through your checkbook just to make sure that you're not missing anything. Any questions on this page? I tell people, yes, you need me to go back?
Yeah. Yes, on the itemizations for medical expenses. So if I understand you correctly, it's possible to deduct the monthly health insurance premiums that come out of a person's paycheck, for example, as well as long-term care health insurance premiums on the Schedule A, if you're filing as an individual?
Okay, so the way that works is that health insurance premiums, and the reason I put it there that way is because some of us are paying health insurance premiums because we collect Social Security. And so there's a Medicare portion that comes out that counts as a premium. Some of us also have what we call supplemental insurance policies for health insurance, where we're paying Anthem additional money. And this is mostly for retirees, because what happens is most people who are actually working a job, a W-2, their health insurance premium will not be deductible if it was already pre-taxed. And that's what I was saying earlier, people who have already had their health insurance premiums pre-tax cannot turn around and put it on Schedule A as well. It's just for those of us who are not doing pre-tax, and that's usually your retirees. Your retirees are the ones that have the health insurance, the long-term care. Hopefully more of us have long-term care besides retirees, because we're all going to need that. You need long-term care before you need life insurance, to be honest.
Yeah.
Probability,
Okay, so,
you're going to need long-term care before you need life insurance, but go ahead.
so long-term care insurance premiums are deductible whether you're a retiree or you're still working, or?
Correct.
Okay, thank
Correct.
you.
Because long-term care, even if you're paying it out of your job, it is not pre-taxed. Long-term care is not pre-taxed. Health insurance is, but not long-term care. So you can, so the thing about it is, the reason I was trying to explain is Schedule A, when you put the things in medical that you're entitled to, there are a lot of people who still can't deduct it because it doesn't exceed 7.5% of your income. And because it does not exceed 7.5% of your income, that's where the state comes in and says, you know what, we will let you deduct it over here then. Because most softwares, well, at least the software I use, I have to put long-term care insurance premiums on a different, on its own designated line, so that if the system is not allowing me to deduct it for federal tax purposes, it knows to allow me to deduct it for the state. Because because you can't take it in both places. So did I answer your question?
Yes, you did. Thank you.
You're welcome.
Yeah.
Gwen, I have a question. Would you go back and tell me about the Medicare premiums?
Sure. So Medicare, when we get our Social Security, it has a reduction in it, a deduction automatically in it, for where we're paying Medicare insurance, Part B or Part A or I think we're paying Part B. Okay, well, this year was $2,041. I remember that figure, $2,041. Some people might be paying a little higher if your income was higher, but ours was $2,041. And then what happens is, if you have signed up for supplemental insurance, like with Cigna, Anthem, where you are also, they're also taking from you, not from the Social Security check necessarily, but they are taking, you are paying a premium to them for health insurance, then that also is deductible. So you know the two figures I'm speaking on, Marion, or you don't?
Yeah, I understand. I've seen the statement on the Medicare statements. As a state retiree, my supplemental health insurance, the state health insurance, is being taken out of my state retirement check.
And that is deductible.
That is deductible.
Yes,
okay.
Ma'am. Yes, ma'am. And so that goes on Schedule A, and providing the whole picture takes you above the 7.5% is when it becomes deductible or not. It all depends. It's hard to get over 7.5%. Yeah. But it's not impossible.
Yeah. But okay, my question is the health insurance deductible for at the state level, if you, do you have to, well, let me rephrase it. Do you have to hit the over 7.5% for the health insurance to be deductible at the state level?
And that, so the answer to that is you cannot deduct on the state level if you took it on the federal level. The state is giving you a break if you were unable to deduct it on the federal level only.
Okay.
So if you can't deduct it on the federal, they're saying, okay, well, come over to our side. We will at least, they ain't gonna let you take the health insurance, but they're gonna let you take long-term care.
Okay.
Got it? Okay.
Got it.
Any other questions? The next thing is I'm asking folks to try, I know that some people, we got discouraged not to file early because we were worried about the taxes on that $250 to $500. Okay, but the government says okay to file now. But those who are receiving earned income credit, don't be in a rush, because see, y'all tax returns take a little bit more, because that's where there's a lot of fraud that is existing with tax returns of people claiming earned income credit. So they have more work to do. And if you can just imagine that the IRS they've been behind for a minute, so I can imagine they're probably still behind. It takes a while to get a refund if you have filed earned income credit. So they're saying don't expect a refund to show up until March. That's what they're saying. Download, if you want to know whether or not where your refund is, this gives you an idea that you can download IRS To Go app on your phone. And then I don't know if people know about the identity protection opt-in program, but I don't know why everyone is not in this program. Now, I can't say I am. I'm just saying, boy, is this a smart move, because people have lost, their identity has been stolen. People's tax returns have been filed on their behalf and they didn't even know it. And the IRS has not caught up quick enough and processed refunds to fraudulent people that should have never gotten the money. So what they did was they implemented, because I have a family member that's going through it right now whose identity was stolen. And so every year, him and his wife get a 6-digit code that I must key into my software in their tax return in order for the system to accept an electronic return on their behalf. So without that 6-digit number, that their tax return can no longer be filed with the IRS. So that safeguards, anyone trying to steal their identity again. Well, why wouldn't we want to do that for everybody? Not just, it's like we need to do things preventive. So this is the way we do things preventive. They're telling you, sign up for it. Sign up for the identity protection opt-in program so that you do receive that 6 digits. You have to give it to your tax preparer every year, and the 6 digits change every year. And they know them 6 digits expire at the end of 22's taxes. You're gonna get something else for 2023's taxes. So that's a good thing to do if you're interested in doing that. That is my last slide that I know of. It is 12:29, but I'm sure Randy and Zelda will give us a little bit more time. But now is the time for questions. I am going to see if I can do my homework while I am while I have everyone here, and see if I can share. I might need help with this, James. I'm trying to see if I can send everyone I want to send everyone the PDF of all my slides that I just got through doing. I can put it into the chat, and then y'all can keep it, do whatever you want to do with it, if you choose. And I'm trying not to, I will try to answer any questions for you as we are talking. They showed it to me earlier. Where is Randy and
yeah, Gwen. Yeah, you send it to us. We'll make sure everybody gets a copy of that.
Okay, you just want me to send it to you?
Yeah.
Okay,
we can send it out.
But you know,
Well, you can
earlier
put
I
it-
was able to go on here and find that doggone
Yeah, either way is good. You can do it there.
Okay, all right. So you have everyone's email address that's on this call?
No, no. Oh, and by
Okay,
the way,
RCP.
quickly, Gwen, I
Yeah.
think in order to get back to the chat, you have to stop sharing your screen.
Oh,
Renee
thank
says
you.
Renee says you can get there without that. And she knows
Okay,
better
okay,
than I
okay.
do.
So James, do I hit N for the stop sharing the screen? Where is the share screen at?
Thank
This one right
you.
here? Oh,
Thank
stop
you.
sharing. Okay, I
This,
got it now. Okay,
this,
I did my
this
stop
camera's
sharing.
stuck.
Oh, it's right here. It's right here, James. I got to go on the file, go down to your computer, and then I got to go find it in my documents, and then I'll be able to put it on there. Wow, I'm learning something new every day. Not just taxes, I'm learning how to operate Zoom. Okay, let's see. I actually don't see the one here, tax. Okay, and I wrote down where it's at. Just give me a second, y'all. It's under PC, it's under documents, it's under tax tips seasons. Tax tips, hit documents. And I'm going to tax tips seasons. Tax tips season 22. Tax tip.
All right, while she's doing that, if you want to put any questions in the chat, or if you all want to raise any questions, we can certainly get the question period going.
Yeah, but that's not the PDF. That's not the PDF. I got a PDF here. So let me find it. Tax tips season.
Right. Zon, Z-O-N.
Hey, Gwen, while you're doing that, we're just going to tell everybody about the next meeting.
See, I had it too, man.
Our next meeting will be on Saturday, March 18 at 11 o'clock. We're going to pick up our study of Tiffany Alice's book, Get Good with Money. For those of
That's not it.
you've been following that book along with us, that's chapter, we pick up on chapter 4, 30% whole. And the topic is digging out of debt.
That one in PDF.
And it's an audio book. So for those of you who don't have the book, you don't have to purchase the book. You just log in like you did this morning and we'll play the audio book about a half an hour, and then we'll discuss the book afterwards. So join us on March 18, Saturday at 11 a.m. We'll get the link out as we did for this meeting.
I'll save as a PDF.
Okay. I need to go back and find it.
There are no questions?
So there are no questions. Oh, okay.
There's a question in the chat. I'm trying to type a question, but I'm slow. I'm trying to type one, but I'm slow. What about Zelle and Cash App and PayPal? Is anything done about that? I could keep hearing that they want to tax funds that we receive through that.
Okay, so this is what I heard. So there was so much complication with trying to come up with the ability to tax people, because the limit was 20,000. It used to be you had to receive $20,000 in order to receive a third party thing from Cash App saying, oh, you received X amount of dollars. And the IRS received so much controversy for doing it, trying to do it, they decided to eliminate, not to do it. So the limit right now is 20,000. So you're not going to receive anything telling you that you have income from there unless you do receive 20,000 or more.
Okay. Thank you.
You're welcome, Mary. In the chat is asking, you pay $8,000 for long-term care. It was not paid from a deduction. It was a direct payment. Is it deductible only on Schedule A if you itemize? So I would put it on there, and if you do not itemize, then most certainly put it on your state return. Because if you put it on the state return, you can deduct it. It's just that you weren't able to deduct it on the federal. Because you can't deduct it in both places. That's impossible.
And there's
Any other
another question, this in the chat, are COBRA medical premiums also tax deductible?
So COBRA medical premiums is also, I think that's still health insurance. If I'm not, I've heard the word COBRA medical, that's still health insurance. So it applies to that just as well. Because people who are paying COBRA, it's probably not coming out of a paycheck. It's probably something you're paying directly. And so therefore it was not pre-taxed. If it was not pre-tax, then it's deductible on Schedule A, provided you can use it on Schedule A. So let me see if I can. So James, okay, I have the file pulled up that I want to share, but it won't let me share it because I have it pulled up. Is that what happened?
Can you cut and paste the
Okay,
link in the
let me
chat?
try for a second. Give me a second. Stop the video. Stop.
Okay, anyone else have any other questions while we're getting that straight?
I'm gonna just confirm, this is LaShara. The healthcare, like if you have insurance to the healthcare.gov, the Affordable Care Act, that's a premium that's not pre-tax, like self-employed, and you're doing that. So that's also deductible, correct? As I understood. Okay.
Correct.
All right.
Okay, I know. Hi, everyone. It's Colleen.
Hi.
How are you?
Good.
In regards to, I know the young lady just asked about the Cash App reporting, but on the Cash App website, it talks about if you have, the IRS will is required to require the Cash App to issue a 1099-K to cash for business account holders. And then they have different thresholds, and certain states have different thresholds also. So just look and see if your state is one of them. Like for me, Massachusetts, the Cash App has to give me a 1099-K if it's, you know, reached the threshold of 600 or more. So just keep those in mind. So Cash App has on their website, they tells you who will receive a 1099-K or not.
Okay.
So
Cash App.
I can, well, hold on, I'll put the link inside the chat.
Okay,
Make
thank
it
you.
easy. No problem.
And I just see that like Gwen got the link in.
Okay, I just put the link in for all of the PowerPoint slides that I just got through doing. So it's there.
Great.
That you can pull up and then save it onto your computer. Whoever, Eunice, if you have medical expenses above the premiums, are they also deductible? So yes, so medical expenses are things like your co-payments to go to the doctor, to the lab. We have people who had major dental work done. You can have, you may have ridden in an ambulance and had to pay for it. There are medical supplies are also deductible. So medical represents a whole lot of things, but the point is that whatever makes up all of your medical things, they have to exceed 7.5% of your income, and only that which exceeds the 7.5 becomes deductible. So you're not going to deduct it all. The first $7,500 per 100,000 you make of adjustable income will not get deducted. It's only that which exceeds it gets deducted. Okay. It's very hard to do. I'm not saying it's impossible, because it is possible. It's just that it's a very hard deduction to get. But okay, it is possible.
Thanks for the clarification.
Oh, you're welcome.
Gwen, the file is from your direct computer, it's from your C file, and we don't have access to it, so we can't open it. FYI.
Oh, so where I gotta take it from? She
You-
says from my C file.
If you put it on Google Drive, you can share it that way. If you put it on OneDrive, but you have to put it in a cloud. Right now, it's on your physical computer.
Oh, I see.
So you have to
So
put it on
Jane, you know
cloud.
how to put it under, how to put it under, under a Google Doc.
Yeah, you can put it in either in the Google Drive itself, or you can put it in OneDrive if you have that, or Box if you have that. I have 4 different ones that I use.
Okay, all right. Look,
Or
James is getting-
Dropbox.
Okay, all right, James is getting ready to try again, because this is not my area of expertise. Now, I'm talking about taxes with you now, but.
It might be easier just to email it.
Yeah.
It's easier just to email it?
Yeah, email it to Zelda and Randy, and then they can send it out.
Okay, but I thought they didn't have everybody's email.
Oh.
Yeah.
Oh, yeah, put your email in the chat.
In the chat.
Yeah.
Put your email in the chat, and then
you can
I will send it to Zelda, and then
Yeah,
she
you can
will,
notify me if you don't receive it, and I can send it to you individually as well.
Yeah,
Oh,
okay.
okay.
So everybody put your
That's
email
better
in
for
the
me.
chat if you're interested in receiving my
We'll make
paper.
sure everybody gets it. We'll make sure everybody gets
Okay. Well,
it.
that
Any other questions? Any other thoughts?
Not a
comments?
question, but a comment. This is Kimberly. I just checked the chat Cash App link, and Virginia is distributing a 1099 to anyone who exceeded the threshold of $600 for Cash App. So make sure you go
So the state of
online.
Virginia, you said the state of Virginia is doing it?
State of Virginia is one of the ones that is issuing 1099s. Sad face.
Well, you know what? Let me put it this way. When it came out, the IRS was speaking about your normal individual. They were not speaking about people in business, because people in business are using they're using something to swipe like transactions through third party. And so those have always been reported out to them. It's just that they was getting ready to pick up people, your normal person, who I might be getting money from you because I treated you to dinner yesterday and you need to give me back my money. So I done treated you to dinner, you need to give me back my money. You gave it to me through Cash App, and I've done it every month now for 12 months at $100 a month. So now I got $1,200 that you done gave me. That's not fair to me that I now got to pay taxes on the $1,200 and you just reimbursing me for dinner. So that's the part that I saw the IRS said, no, hold up, we're not even going to deal with that, because it was the normal person. So I think that's a difference between that and somebody who is actually in business of collecting money through third parties. At least that's what I saw. And I don't know how the state think they're going to issue something the federal government ain't issue. It can't even be taxable on the state side if it's not taxable on the federal. The state gets their data from the federal. You can't even file a state tax return that they link. You can't put one thing as income on a state return that's different than what's on the federal government's return. I mean, we all know that, right? When I file taxes, you're federal. Sifford, am I right?
You're right. Preach.
Preach. Yeah. Your federal is what guides the state. So if the federal government is not accepting these 10, whatever they call from Cash App, then how in the world the state going to accept it? That don't even make sense, does it?
No, it doesn't.
No, I don't believe
Great presentation, Gwen. Great presentation.
Thank you, Sifford.
All right.
Does anyone else have any questions? I am so happy y'all spent some time with me today. I've enjoyed this. Hopefully I could be the bearer of better news next year, but y'all need to be working on stuff right now for next year. Don't wait to the end of the year. Y'all get that it's deductible, because that's your loophole. You need to clean out the closet. That's the only thing I can tell you. Clean it out. Or clean out them attics. Some of y'all some of y'all got storage bins in the backyard. Y'all need to clean them out.
Clean them out. Hey, Gwen,
Yes,
is there
ma'am.
anything we can do about purchasing eggs? Like, is that in the category yet?
Purchase. You know what hey, Gwen. Hey, Gwen.
Donate some money to a candidate.
I don't buy them.
Take out a home equity loan.
So you know what I did about purchasing eggs now? You said eggs, right? Is that now I don't eat as many. So when I sit down to my grits, I'm so used to 2 eggs, I just eat one. You know what I'm saying? I ain't got to have 2 eggs now. I eat one.
Or if you find someone with chickens that are selling it on the side as their extra income.
Hey, Gwen,
I just want to make sure there's no more. I need to make sure there's no more task questions before I stop the recording, because we are still recording. I just want to make sure we're safe. Any more task questions?
No, we got to get our thank you. We need to put that into the recording as well.
Okay.
And Gwen, on behalf of the ministry, thank you so much.
You're welcome.
And you know, you made the comment, you know, hope you have better news next year. We know that you keep it real, that you do your work. You have years of experience. You have a good heart, you and your husband, who I know helped you in these presentations. And that's why you're always in demand every year. And we always look forward to this because
for next year.
You know, numbers don't lie. And
yeah,
you know,
no, numbers
people
don't
make
lie.
the numbers sound good, but don't give you what you need. That's not what we need. And you
so
and
yeah,
we
so let me
notice
ask
the
you
difference
this.
on our taxes.
Yeah.
So
Right.
thank you.
And someone asked a question, I think it says, Pam, thank you. How about another talk on how to do our homework? And that is a good subject because there's so many things that we don't take the time to do to help our situation. I named a couple of them because a lot of times we're so used to, we're happy when we bring home a couple extra dollars in our paycheck, not realizing that federal government, sometimes the state government, are going without their pay. And then you're going to get hit up for it at the end of the year when you get into the following year, and you never even realize because it wasn't their fault. And I'm gonna tell you another flaw that I have seen a lot, and that is persons who have more than one job. Because what happens is the two payroll systems do not talk to each other. So if you have one payroll system thinking that you only making $25,000, then most likely they ain't gonna take much taxes out on you because the first $13,000 is not taxed anyway. So they're not gonna take much, but lo and behold, you got another job that you make 50. So you're in a whole nother tax bracket with that 25 from the small job, but something didn't trigger you that, you know what, I need to tell that smaller job to take more money out because all of my money now is gonna be sitting in a higher tax bracket. All of it's not gonna be sitting in a 10%. Now I'm up in the 22%. You got me? So sometimes we don't do that kind of homework just to make sure we have ourselves covered. And the other thing, we don't save for a rainy day. When I say save for a rainy day, I'm talking money out of the paycheck saved while you can have the money deducted, and then it's already reduce your wages on your W-2. Therefore, you're going to pay less taxes while you're saving for your retirement. We have to save for your retirement because if you don't think y'all gonna live up off that Social Security, I got news, but hey, that's a whole nother workshop. You're not gonna live off of that Social Security. You need something else to go with it if you want the same standard of living. Let's put it that way. So anyway, yes, it's been my pleasure to help.
And actually that's exactly what we're studying in our book with Tiffany Aliche, how to do our homework so that we can find money to save up for retirement,
right,
and do all that.
Right. And that's the one you put in here for March the 18th, you said?
That's March 18th. Yeah.
March 18th. Okay, so everyone knows, and hopefully they can sign on to the link and do that because that is so important. And it is. There's a whole lot of other subjects too, but we don't have to get into all that. Someone says, does have anyone know a good financial advisor that specializes in retirement? I wish I did. I do have one. I'm going to reply to this so that everyone can see the message, see my answer. This person that does retirement plans. I just gotta go to my contact to find him, and I'm gonna put him in Lane. Okay, I'm getting ready to type it in now for y'all. Let's call
And,
it
and while
Lane.
you're doing that, also, while you type that in, I just want to note, you know, I encourage the role of the ministry is not to point or direct anybody to any one thing. But if a presenter like Gwen wants to put a name out there, that's fine. I'll also note that Michelle Oliver is on the line, is participating in this. She's a former presenter, and she's been a financial advisor for years and years and years. That's where you see ASALH, Richmond, Virginia. That's her.
Okay, because I don't have to put this one out for real. I don't have to. If we have someone on here that can go ahead and type in theirs, are they on here now? Let them type in theirs. I don't have to put this one in. I haven't hit it. I haven't hit it yet.
I am sorry. I hear you, Randall. Thank you for saying, I'm not sure what you were talking about. I'm doing 3 Zooms at one time. I'm presenting.
Because you're a former presenter.
I'm trying to. So I'm not sure what just happened, but I would, if you are putting something in the chat for your business, go ahead and do it.
Yeah, so it said, the question was, does anyone know a good financial advisor that specializes in retirement? And your name is the one that suggested. So if you would like to, can you reply to the chat with your information so that people will know how to contact you?
I know you had a business. I don't know if you're still in that field or not.
I am trying to sell my business, but I specialize in life insurance now. I deal with life insurance and life insurance only now.
Oh, okay.
Okay, so I'll go ahead back. I'm gonna go ahead back and put in who I was going to.
Thank you. Are they African American? Because I would love that, so I can refer people to that person.
That's my problem. This person is not African American,
and I can't find anybody either. But I would, if you can send that.
But I do know African American. No, let me back up. I do know African American, but this person's in Atlanta. This person's not here in Virginia. This person's in Virginia. But
okay.
I'm an African American that's in Atlanta, then I can hook you up with that.
Yeah, I'm in Texas. So someone in Atlanta, it doesn't matter. Yeah, I'm in Texas. That the person I'm asking the question, I'm in Texas.
Okay. Both way. I mean, if you can put both of those names in there for me.
Hopefully
okay, I'll get ready to do it right now.
Thank you.
Yeah. Hopefully they're fiduciaries.
I believe so. All right, so I'm getting ready to put the number in right now. And then I'll put the other person in. This person's African American. Do I need to say that on here? The first person I'm sending to you is African American. Do I need to say that?
No.
No, you don't.
And Zelda and I can put our financial advisor, his information. He presented a year ago.
Yeah, he's one of our presenters as well, Deshaun Chapman.
He's with Northwest Mutual. So we'll put his information in there. So you're welcome to reach out.
So I'm putting in both for you. So the second one is not African American.
And I'm not sure if you went over fiduciary today, but a fiduciary is someone who has the financial advisor is making sure that your what you need and what you want is for you and not for them. I'm trying to break it down to the least common denominator. And I am a fiduciary, and you have to go through a little bit more in order to get that title. But fiduciaries do look out for you versus looking out for them and how much they're getting paid.
Okay, very good.
Thank you, Michelle.
Okay, you want me to stop recording yet, or you want me to keep?
No, we're gonna have.
We're going to end the meeting in the closing prayer. If we would all take a moment and bow. Thank you, Lord, for another day. Thank you for allowing us to gather virtually for this excellent presentation. Thank you for our presenter, Gwen Carney, and her husband and her family. Thank you for her knowledge, her wisdom, her care, her expertise, her willingness to give a little bit of her knowledge to us, that we may become better stewards of our finances, that in turn we can become better Christians, that we can spread the good news, and we can be secure knowing that if our homes are good, if our finances are good, that we are better situated to ultimately bring other people to that which you want us to bring. Thank you for everybody who is on this call. Bless them in a special way. Bless those who, for whatever reason, could not be here. Let something have been said today that will bring us to where you want us to be. Make this world a better place. It's in your son, Jesus' name, that we do pray. Amen.
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 Thank you, everyone, for coming.
Thank you.